Hello, everyone. My name is Philip Palumbo. I'm the host of the Palumbo Pulse, where we interview some of the most successful portfolio managers in various markets, market strategists, and economists. Today, we have with us Andrew Clinton of Clinton Investment Management, with over 30 years' experience navigating the municipal bond space. We're lucky and fortunate enough to have Andrew partner as a firm to assist our clients in managing their municipal bonds. So, Andrew, thank you so much for joining us today. We really appreciate it.
Thank you for having me.
All right, great. Great. Yeah. So the main impetus really for this podcast today was for you to give us an update on the municipal bond space. What are things looking like in terms of value as it relates to municipal bonds and the health overall of municipal bonds?
Yeah. So it's as I was saying, the take a step back here. Obviously, last year was a very difficult year for fixed income investors and municipal bond investors in particular. One of the worst bond markets in history, certainly over the 30 years I've been in the industry, worst one of experience of that we've had as well. It's just a very, very difficult year. Having said that, this year has gotten off to just the opposite start. It's been really an incredible course of events since interest rates peaked in November of last year in 2022. Rates have come down fairly significantly already, which may be a surprise to many who are not perhaps paying very close attention to the market. But so peak rates are in our view. The outlook for munis is quite good, especially as it relates to our strategies, which tend to be more focused on delivering higher income and higher return. We've actually are outperforming both benchmarks and peers on a year-to-date basis by a significant margin. All of that being really driven by our anticipation of what was forthcoming, and that is that the economy is slowing. That we were likely headed toward recession, which we've been talking about with our clients and through our commentary for some time, and have positioned client portfolios accordingly. So the outlook for munis is broadly very positive in light of the fact that state and local governments have record rainy day funds and general fund balances. In terms of tax collections, took in more tax revenue in 2020 during the pandemic than they did in 2019. They took in almost 25% more tax revenue in 2021 than they did during the pandemic. And they were given $500 billion to recover from taking in more tax revenue than they've ever taken in their history. So it's really a remarkable moment for state and local governments heading into this cyclical slowdown. And so while it is likely to be a recession that I think may be worse than most are expecting, for municipal bond investors, they need to fear not, because state and local government credit quality is probably the strongest it's ever been in my career, heading into a cyclical slowdown like we're about to see in a recession.
That's really great to hear. So tell me talk to us a little about the default rates on municipal bonds, historically speaking.
Yeah, so most people come to the municipal bond market because it's primarily a very, very safe marketplace in terms of default experience. To say it's low is an understatement. The default experience in the investment grade category of munis is less than 1%. Even if you go from the AAA rated bonds down to the BAA rated bonds, which are considered by Moody's and S&P to be speculative, the default rate in the BAA segment of the marketplace is not materially different than that of AAA. So AAAs don't default as it measured by the Moody's credit default studies going back 50 years. And then BAA rated munis default at roughly 1% of the time, meaning that 99% of all municipal bonds that are rated BAA tend to mature without a credit event. And for our clients, we've never had a default. So that number is zero as it relates to the BAA rated bonds that we invest in. So the yield advantage is high right now because yields are still considerably higher than they were at the beginning of last year. And we think it's a great opportunity for investors because we don't expect that condition of higher rates to last very long now that the Fed has what we think has moved rates up for the last time. And we know from history, after a pause, there's traditionally never another rate increase, and likely the next move is a cut. So a cut in rates would be good for bonds because yields are falling and that pushes up prices. So our outlook is quite optimistic for the future of our strategies.
As far as yields, where are we today in regards to yields? And just, this taping is May 11th. So as of today, where are yields on various parts of the yield curve?
So depending on where you're looking, it's pretty unique in the muni space. I'm going to read just from my notes here, and that's that it's a rare moment in the municipal bond market where you have an inverted curve between 2-year bonds and 13-year bonds, meaning that you get lower yield for a 13-year bond than you do for a 2-year bond. And you say, well, why is that so rare? It's the treasury curve has been inverted for almost a year now, and that's true. It's rare because it almost never occurs in the muni market. It certainly hasn't in my career for an extended period, as has been the case recently. Having said that, what's more interesting in my view is the fact that while the muni curve is inverted between 2s and 13 or 14-year bonds, it's actually positively sloped, meaning you get more yield as you extend out beyond 2 years and beyond 13 years. It's positively sloped by almost 100 basis points out to 30 years, which is not what's happening in the treasury market. The treasury market 2s to 30s is still inverted. So that means that the long end of the muni market is dislocated. It's mispriced for what we think is likely to be lower rates in the future. So therefore, the opportunity set is greatest not in the 2 to 5 year or 2 to 10-year area of the curve, but really further out the curve in longer duration assets. But to answer your question directly, yields in the front end of the curve in the 2-year space right now for AAA rated bonds are roughly 2.6%.
That's yield, is that yield to maturity, Andrew?
That's yield to worst. Sorry.
Yeah,
yield to worst. So 2.6% for a 2-year bond. For a 10-year bond, it's 2.3%. So there's that inversion that I was talking about. For a 15-year bond, it's 2.9%. So there's the positively sloped nature that I'm referring to.
Yep.
For a 20-year bond, you're looking at 3.12%. And for a 30-year bond, you're looking at 3.36%. And that's assuming that you're a AAA rating in every one of those spots on the curve. So on a taxable equivalent basis, as you're looking out the curve and you're looking over 3% type yields, you're looking at taxable equivalent yields for those in the highest tax bracket of over 5%. And for our clients and our strategies, just so you have it, our credit opportunity strategy, we're targeting a yield of 4%, just over 4%, which is taxable equivalent over 7. And our market duration intermediate strategy is targeting a yield of roughly 3.25%, so almost 3.5 to be exact. So again, very attractive. But the difference between those two is that credit opportunities has a single A credit quality, whereas the market duration strategy has an average credit quality of AA.
So you're targeting a yield to worst of 4%?
That's correct. Yeah. Which again, this speaks to the opportunity in the muni space, and especially our credit strategy in particular, since as we just said, municipal credit quality is generally very stable and will remain so for the next couple of years. We know from, and this is comments from S&P in particular, that the $500 billion that was given to state and local governments is largely unspent. Roughly 50% of the $500 billion that was given to state and local governments has still yet to be spent. So the state and local governments, together with their rainy day funds, have enough money to ride out this difficult recession that we are now expecting. And so we're expecting credit quality to remain stable, which is why we're comfortable moving down in credit quality. Not because, generally speaking, as we said, munis don't default, but we as a manager are trying to find credits that are going to outperform, right? And so doing, we want to pick up yield wherever possible. So we're delivering in our credit strategy and our market duration strategy, for that matter, equity-like returns from the cash flow alone. And if you think that rates are going to fall, as we do, and we think they're going to fall precipitously, the total return opportunity is quite substantial. We think there's a very realistic probability that investors could probably achieve somewhere in the neighborhood between 8 to 15% returns, depending on which strategy we're talking about, on a total return basis over the next 12 months.
Right. So I want to make sure that the audience understands what you're saying. So the past 10 years, the S&P 500 has averaged around 11%, which was above norm, right? Mm-hmm. And what we talked a lot about in 2021 when valuations were really high, and valuations are actually still high with the market, north of around 18.5 times forward earnings for 2023, we're probably looking at an average return in the S&P somewhere around, I would say 7-8%, if I had to guess, maybe even a little bit lower. So what Andrew, you're trying to say to people or investors is, I can get you 4% yield to worst, which is taxable equivalent of 7%, which essentially is what most likely the S&P will average going forward. We're talking about significantly less risk. You just talked about default rates of 1% in the BAA space. Historically speaking, in your space, the default rate is, I think I got this right, 1% of 1%.
Correct.
Right? Somewhere around that. So, and that's what I want to make sure that's clear to everybody, number one. Number two, if I say to you, Andrew, why do I need to invest with you when I could buy a 3-month treasury bill or a 6-month treasury bill, get 4 to 5%, and I'll be going out 3 months and 6 months. Why would I waste my time investing in municipal bonds?
Yeah, it's a great and timely question. We're asked it all the time. And it's important, I think, in the context of helping clients really understand the arc of history. And that question has been asked many times over the course of history. And we actually talk about this in our recent commentary, where we try to remind investors of the experience of the 1980s. We've heard ad nauseum over the last year how similar this period is to the 70s and specifically the 80s in terms of the ongoing inflationary pressures and how similar that was. But we're trying to get clients to think about is, well, what happened after that, right? What came after? And what we know is that interest rates were very, very high, to say the least, right? We were looking at interest rates on money market funds in the 80s of roughly 17%. Or you could invest in 10-year treasury bonds at 12%. And people were asking that very question that you very appropriately asked at that moment in time as well. Why would I ever extend out to a 10-year bond that's yielding less than my money market fund is today? And the answer, and you know the answer to this, I'm sure, is that because you're not going to get that money market fund rate for the next 10 years, or the next 15 years, or the next 20 years, right? The long end of the treasury curve, by being lower in yield than that of the 2-year today, is telling investors that interest rates are coming down, and they're going to come down materially. So yes, it's very attractive and it feels comfortable and it's warm and cozy in that money market fund that's yielding 4.5% or thereabouts, or maybe even 5 if you're lucky. The reality is it's simply not going to last. And so as you think out over the next 12 months and you start thinking about, okay, on average, once we've actually paused interest rates, how long has it taken to the Fed to start cutting interest rates? Because they've told us they're going to stay for longer, right, at this higher level until they start to see inflation coming down. On average, it's 5 months between the pause and the actual next rate cut. Oh, by the way, what is the Treasury market already pricing in? They're pricing in rate cuts by the end of this year, which would coincide with 5 months from when the pause would be, assuming their last rate increase was the pause. Right. So, yeah, so that's what we're trying to get clients to think about. Try to think about the idea that these yields are not going to last. And we're telling you they already are lower than where they were just a few months ago. So don't miss out, lock in the yields while you can, because just like in the 1980s, investors are going to look back and say, oh, I didn't buy enough. I didn't own enough of those bonds that I should have. And we don't want buyer's remorse, I guess is the best way of putting it. And so that's where compelling investors who have large cash allocations that they're planning to invest in the market. And to your point, what is the difference between the risk associated with the municipal bond market and let's say that of the public equity markets? It's about 4-to-1 in terms of the higher degree of volatility and risk associated with equities versus munis.
Absolutely.
Yeah, so it's a pretty compelling on a risk-adjusted basis as well.
Yeah. So this is really an important point, right, Andrew? So I remember when I was first in the business, maybe about 5 years into the business, you could have bought a 10-year treasury or a 10-year CD at 6%. Instead, what did most investors were doing? They were buying a 3-month, 6-month, or 1-year CD at 6%, right? And the problem with that is that as rates went down, you were refinancing at 5%, 4%, 3%, 2%, et cetera. So that investor that bought that 10-year bond at 6%, right, versus the one that was so short-term and so myopic, for them to make up for what that investor return going out 10 years, it would take them a lifetime. And that's called the time value money. And that's what investors don't really understand. So the most important thing as people are listening to this is that the first thing people need to understand is what rate of return do you need to achieve your financial goals? And let's say that return is 5%. Well, if that's 5% on an after-tax base, on a before-tax basis, and you're able to get 4%, right, which is federally tax-free, some state tax-free, which is an after-tax equivalent of 7, and you only need 5 to achieve your financial goals. If you understand that, then it's okay to go out further in the yield curve, lock in these where rates are high right now, because most likely, and there's no guarantees, of course, but we are in a disinflation type of environment today. The Fed is closer to the end than the beginning. And I want to talk to you more about this, looking at all the economic data, there is a good chance that we can be in a recession, which means the long end, which is telling us already that rates will come down. So This is why I'm really trying to. A lot of clients ask, "Well, Phil, my treasury bill just came due. What should I do?" I mean, municipal bonds. There's tons of value there, and
Right.
we just explained exactly why it's value. So good stuff. Um, I want to. So the sweet spot right now, in your view, where is the sweet spot on the yield curve?
So right now for our clients, what we're doing is creating a barbell structure where we have a higher weighting in shorter term bonds because of that curve inversion that I mentioned and avoiding the areas of the curve that we expect will underperform. And we have a higher weighting further out the curve in longer duration assets. So the average duration is still a long bias relative to the benchmark because we expect rates to come down, and they have, which has allowed us to outperform. We
Mm-hmm.
expect more of that. But the benefit of the barbell is that you're avoiding the actual, if you will, the dip in the belly of the curve that is very unattractive. And that when rates come down and the curve normalizes, the long end's going to come down more. And it's interesting because we expect the municipal curve to flatten as the treasury curve steepens. And that speaks to the dislocation between the two markets right now. You might ask the question, I think understandably, why is it that the municipal bond market is dislocated from the treasury market? And the reality is it's the nature of the end buyer, right? Who are the end buyers of the municipal bonds? That generally speaking are individual investors who buy bonds and never sell them, right? They hold them to maturity. And their thought process is simply, well, I want the most yield for a specified period of time. And I'm not willing to extend out because I might need that money in this period of time. The reality is the liquid nature of the market is such that there are times when you do not want to buy certain maturities and areas of the curve because they're relative on potential underperformance. That's what's happening right now. So we're structuring portfolios in such a way to overweight those areas of the curve which are further out the curve, as I mentioned, that are likely to have more roll down, which is more
Right.
total return,
Right.
together with the front end, which is going to also gain value as rates come down, and avoiding the middle area of the curve, which is likely to underperform.
So, Andrew, I know you're an active manager and you're biased towards this, right? But you're a very honest and trustworthy investor, right? And or else I wouldn't be working with you. So when people say to you, Andrew, why should I hire you when I could just ladder individual bonds on my own? What is the difference? And why should I pay that extra fee to have your active management?
Yeah, it's an excellent question. I like to use the analogy, it's so I don't know if you ski, I ski. So it's two people at the top of a mountain, both of us with skis strapped to our boots, right? And we have a choice which path to go down, right? We both can go down the green or the blue paths, probably if we're comfortable skiing. But maybe one of us is not comfortable going down the path that actually offers maybe a more exciting ride, but would you be safe doing it? The reality is in the municipal bond market, the difference between those paths is higher return or lower return, right? And so when we think about how we manage portfolios, people don't hire Clinton Investment Management to do the same thing that they do, right? You're hiring us to do something different. You're paying us a management fee to add value, to do something you will not likely do yourself. And I have every confidence, having done this for 30 years, I've yet to meet a client who does what we do, because this is all that we do all day, every day. I would never presume that somebody who owns a restaurant and is an exceptional chef, just because I actually might be handy in the kitchen, that I could create a dish as eloquently and perhaps as savory as they do. The same is true for investments, broadly speaking, not just for us, but across asset classes. So we're gonna do things differently. We're gonna add value. You can see that in our track record and performance relative to peers and benchmarks. And that should be investors' expectation, right? They should expect us to add value, and we're going to be accountable to them for that.
Absolutely.
And that's I would say that's the primary reason why. And also it comes down to realistically accessibility. Are you going to be able to access the capital markets in the same way an institutional manager would? Are you going to be able to execute at the same prices that we do? Are you going to be able to identify credits that are improving, if not stable, as opposed to then some that might be maybe not as stable?
Right.
Just because we think broadly credit's going to be stable doesn't mean every credit will be stable.
Right.
And so that's the type of thought process and deep research that we do, which we understand clients just don't have the resources to implement themselves.
Excellent. So I want to close out with talking about recession, right? We've been hearing this for now for at least 2 years. And the way I look at it is when you look at all the economic data, most of the economic data, it points to a deceleration, but the rate of change deceleration has definitely slowed down, right? In some of the indicators that I look at. So this here points to a recession. Earnings year over year are down negative, right? So the deceleration in earnings has occurred. I mean, originally EPS, earnings per share, for 2023 was 250. Now it's down to around 217. So it has continued to revise down. But yet you have the jobs numbers and the job market very tight, except today was the initial claims numbers came out, which is the worst since 2021, right? So mm-hmm. So we're starting to see that now creep up, which, by the way, is very common after the last interest rate hike. It takes on average 14 months to see the change in the job market. It's literally almost like right on point. Right. So I feel like this is how it's interesting. This is how I equate this current environment. I equate this current environment as a slow bleed that will eventually bleed out. Now, by the way, I actually believe we did bleed out with Silicon Valley. In other words, what I mean by that specifically, on that weekend when they blew up, if it wasn't for the government backing deposits, Monday would have been worse than October 1987. Mm-hmm. So, and it's because of the government backstopping those deposits why we didn't have a major crash. So that's when I talk about a slow bleed, a bleed out. I believe we did bleed out, but if you want to say, okay, great, we didn't there, but at some point we will. And it's because of the velocity of the increase of what the Fed has done. So again, people have been talking about recession for a while. It hasn't officially happened yet, or maybe it is, or maybe we're in one right now. So that's a lot that I just said, but what are your thoughts overall? And what I'm saying, why we are not there yet, et cetera.
Yeah, we generally agree with the premise that the economy is slowing rapidly, right? We know that from the GDP numbers themselves. We've seen three decelerating quarters of GDP growth. I mean, you have basically already at stall speed for the first quarter, 1% GDP growth. Right. And that's just above contraction, right? So we have other data points as well. We know that over the course of history, anytime you've had 12 consecutive months of declining leading economic indicators, that has been associated with recession 100% of the time, right? We also know that in history, when you've had a decline in inflation, this is really important to mention, right? Both in the context of outlook for fixed income as well as the broader economy. When you've had a decline in inflation, like we have seen on a percentage basis, we were over 9% inflation in the summer of last year. We are now down to 5%, just under 5% inflation, as we learned this week, right? There has been three other times in history when you've seen an equivalent decline in the rate of inflation. The one time, 1971, the other time, 81, 82, and the last time was during the 08-09 financial crisis. All three of them were accompanied by very severe recessions. So this notion that, and we've heard a lot about it, and we didn't dismiss it summarily, but we're just suggesting to clients they think carefully in this context. This idea, well, could we have a soft landing? Will it be a hard landing? Certainly the no landing, I think, is off the table, but we're here to tell clients that the economy has officially landed, and it landed with Silicon Valley Bank. If you think about it, we were first told that Silicon Valley Bank was simply an idiosyncratic event. Don't worry, it's only affecting one bank. It was just poorly managed. Never mind, right? Then we were told that Signature Bank was, don't worry about that. That was just a crypto bank, right? That was totally unrelated. Oh, don't worry about what's happening right now with PacWest, right? And you don't worry about Credit Suisse. No, we need to start worrying, right? There is a problem in the banking sector, and we know from Ben Bernanke himself that the U.S. economy cannot flourish and cannot grow without a stable financial services and banking sector. And we do not have a stable banking sector right now, as much as maybe the pundits might want us to believe. I get it's all about creating confidence and trust, and that's really what financial services and banking is all about. And I'm not suggesting we shouldn't trust the banks. I'm just suggesting that financial conditions are very tight, and they're getting tighter. And that creates certain outcomes that we can predict, right? We know that during those periods of time when it's difficult for banking institutions to replenish their capital structure because they maybe not have as much access to the capital markets as they once did, the only way to replenish that capital is to stop lending, right? And that's what's happening. That's what's going to happen. They're going to stop lending. And when they do that by making the actual terms of their lending very, very severe. And so that's going to have an impact on the broader economy.
Absolutely. Listen, no, absolutely. You're 100% right. So we were in talks with acquiring another business. And when we went through the capital structure of doing so, it just didn't make sense at the numbers. 6 months or a year ago, it totally made sense. Now we're talking about almost 2 times what we were going to pay, or even more than that. So now there's no economic benefit for the seller. There's no economic benefit for us. That's completely stalled. And we're not this huge firm, but imagine, thousands of other firms that are looking to acquire and or sell. And because of the title lending environment, which is and or higher interest rate environment, like you said, it's definitely going to slow growth. I know you're a bond guy and an equity guy. Bond guys are smarter than the equity guys. I'm going to admit it straight up, right? So 2-minute answer, if you don't mind. Last question. Everything you're saying and I said makes total sense. So why the heck is the S&P 500 trading where it is at a forward multiple of just over 18.5 times? What investor would buy into that, knowing that we have this train running at 1,000,000 miles per hour that's getting ready to run us over?
Yeah, it's a great question. It's one that's mystified us for many months now, because it appears to us that the equity market is whistling past the graveyard. The reality is something very bad is happening, and it has yet to reflect itself in the equity valuations. I will tell you this: we know from history that the low in the equity market on average doesn't actually occur until you're more than halfway through the easing cycle,
right?
Which the Fed has yet to even begin.
That's
right.
So interesting.
So this notion that, the Fed, the equity markets are here, are going to stay here, and don't worry, we can look past the recession. It's possible. This time could be different, but the reality is it's totally inconsistent with history. So there is significant risk in risk assets by definition. Mm-hmm. We expect and we know that spreads are going to continue to widen in the high yield credit space, which is a precursor or canary in the coal mine, whichever a metaphor or an analogy you want to use, to what's likely to happen in the equity markets. And so from that perspective, you've made the really important point. We're already in a profits recession. There is no reason, in our opinion, to believe that improves until we see easy financial conditions, which we're not likely to see for many, many months.
Right.
So this notion that the equity market is pricing in reality or is properly reflecting the relative risk in the marketplace, we would push back against. That's not to say that we would ever recommend clients come entirely out of the equity market. We just think right now, as again, going back to the bond market point of view for a moment, it's been rare in history where it's made more sense to be in fixed income than equities. We think now is one of those times.
I agree with
that. That doesn't necessarily mean one or the other. It just means maybe your weighting or balance should be higher to fixed income and lower to equities.
Right.
And then once those opportunity sets change, and maybe we do see some significant easing, and now the upside looks more meaningful to the equity market, and you can switch that balance back again.
Right.
That's really what we're saying. We're saying now is a good time. Keep your capital safe. Mm-hmm. You're getting well compensated in fixed income to do it. I mean, look at the dividend yield on the S&P 500 right now.
Right.
You can get almost 5 times, roughly 5 times what you're getting in the S&P 500 dividend yield in a T-bill. Right. That just doesn't make any sense. Why would you take that risk? It just doesn't make sense.
Right. The risk reward is not there. I totally agree.
Right.
So Andrew, as always, this was great. I appreciate your perspectives on everything. Look forward to continue working together and doing this again and updating our clients and my audience on the municipal bond market. So thank you very much today. Appreciate it.
Thank you, Phil. Enjoyed it. Thank you.
You too.